Nvidia Corporation. The Alchemist's Dilemma. Can Nvidia forge its future beyond the AI gold rush? Introduction. The meteoric ascent. As you read this, billions of transistors are firing within Nvidia's silicon, processing the complex algorithms that power our modern world. From rendering cinematic landscapes to simulating molecular dynamics for drug discovery, Nvidia has evolved from a gaming-centric graphics card maker to the indispensable engine of the artificial intelligence revolution. Its stock price, once a steady climber, has become a parabolic rocket, soaring over 1,500% in the past 5 years. This trajectory forces a critical question upon every investor and observer. What is the future share price of Nvidia, and can it possibly sustain its astronomical valuation? The answer lies not in a simple number, but in navigating a complex web of technological dominance, market saturation, geopolitical tensions, and the ultimate test, turning a gold rush into a lasting empire. Part 1. The Pillars of Power, Why Nvidia Dominates. Nvidia's current valuation rests on 3 foundational pillars, each formidable. 1. The hardware moat, CUDA and the Silicon Symphony. Nvidia's genius wasn't just building powerful GPUs, it was creating a software ecosystem that locked developers into its hardware. For over a decade, AI researchers trained models on Nvidia chips because the tools were there. This created a virtuous cycle: more developers, better software optimization, superior performance, more demand. Today, their Hopper and next-gen Blackwell architectures aren't just chips, they are full-stack computing platforms comprising thousands of chips linked together, forming the only viable factories for giants like Microsoft Azure, AWS, and Google Cloud. 2. The market catalyst, the generative AI explosion. The launch of ChatGPT was Nvidia's iPhone moment. It ignited a global arms race for computational power. Every major tech company is scrambling to build out AI infrastructure, and Nvidia is the sole beneficiary at scale. Data centers, which once bought CPUs for general computing, are now allocating capital expenditure budgets overwhelmingly toward Nvidia's AI accelerators. The market transformed overnight from growth to hyper-growth. 3. The vertical expansion, from chips to solutions. Nvidia is no longer just a component supplier. It's building full-stack solutions. *DGX Cloud, AI supercomputing as a service. AI enterprise software, the operating system for AI development. Omniverse, a platform for digital twins and industrial metaverse applications. Robotics and automotive, drive platforms for autonomous vehicles. This vertical integration increases customer stickiness and expands its total addressable market TAM far beyond semiconductor sales. Part 2. The gathering storm clouds, risks and challenges. The path forward is fraught with existential challenges. Ignoring them is perilous. 1. The competition awakens. The sheer size of the prize has mobilized every competitor. Customers becoming rivals. The Big Three, Amazon Trainium, Google TPU, and Microsoft Maya, are designing their own AI chips to reduce dependency and cost. While they'll still buy from Nvidia for years, the long-term trend is toward a hybrid model. Direct chip challengers. AMD's MI300X is a credible, high-performance alternative, aggressively priced. Startups like Cerebras and Grok are innovating on architecture. Intel is rebuilding its arsenal. The Chinese wildcard. Despite U.S. export restrictions, China is pouring billions into developing domestic alternatives, e.g., Huawei's Ascend. While behind, they will capture the shielded Chinese market. 2. The law of large numbers and saturation. Nvidia now boasts a market cap exceeding the GDP of most nations. To justify further dramatic growth, it must continuously exceed astronomically high expectations. The initial infrastructure build-out frenzy will eventually mature. Once the AI factories are built, demand may shift to a still large replacement and upgrade cycle, potentially slowing growth rates. 3. Geopolitics as a supply chain sword of Damocles. The concentration of advanced semiconductor manufacturing in Taiwan (TSMC) is Nvidia's greatest strategic vulnerability. Any geopolitical disruption in the Taiwan Strait could sever production. Furthermore, evolving U.S.-China trade policies could further restrict market access or supply chains. 4. Valuation vertigo. Nvidia trades at a high price-to-earnings (PE) ratio, even when accounting for explosive earnings growth. This price is in perfection for years to come. Any stumble in revenue growth, margin compression, or market sentiment shift could trigger a severe valuation multiple contraction, hurting the share price even if the business grows. Part 3. Scenarios for the future, mapping the possible trajectories. Let's model 3 potential scenarios for NVIDIA's share price over a 3 to 5 year horizon. Scenario 1. The sovereign AI nation, bull case, share price, significantly higher. This scenario unfolds if Nvidia successfully executes its full-stack vision and maintains its moat. The sovereign AI thesis, where every nation-state builds its own AI infrastructure, becomes reality. Blackwell and successors maintain a 2 to 3 year performance lead. The software ecosystem becomes unassailable, and new markets robotics, climate simulation, drug discovery explode. Earnings continue to surprise to the upside. In this world, today's valuation is seen as reasonable in hindsight. The stock could see further multi-bagger returns, though volatility remains extreme. Scenario 2. The king of a slowing kingdom, base case, share price, volatile plateau with moderate upside. Competition intensifies, but Nvidia remains the leader with approximately 50 to 60% market share, down from approximately 80%. Growth decelerates from greater than 100% to a still impressive 20 to 30% as the initial build-out phase completes. The company prints enormous cash flows, initiates dividends buybacks, and matures into a blue-chip tech staple, like a more dynamic Cisco of the AI era. The stock price appreciates in line with earnings growth, but the dizzying PE multiple compresses, leading to a volatile, generally upward trending plateau rather than a parabolic spike. Scenario 3. The gravity of disruption, bear case, share price, significant correction. A perfect storm hits. A major competitor, e.g., AMD or an in-house design, captures meaningful market share with a superior price-performance ratio. The AI investment cycle peaks sooner than expected, leading to a chip glut and falling prices. A macroeconomic downturn forces big tech to tighten capex. Geopolitical shock disrupts TSMC. In this scenario, both earnings estimates and valuation multiples fall sharply. The stock could experience a deep, painful correction, e.g., minus 40% or more, as the market recalibrates to a new, less dominant reality. Conclusion. The alchemist's true test. Predicting NVIDIA's exact future share price is a fool's errand. The journey will be one of extreme volatility, driven by quarterly earnings beats, misses, and the relentless news cycle of AI. The more profound question is Nvidia a cyclical company riding a once-in-a-generation wave, or is it a secularly growing platform company? The truth likely lies in between. The next 2 to 3 years are still powered by the undeniable wave of demand. Beyond that, the share price will be determined by NVIDIA's ability to transition from selling shovels in a gold rush to controlling the entire value chain of the AI-powered economy. Final verdict. NVIDIA's future is not about finding a new peak, but about building a sustainable plateau at the summit of the technology world. For investors, this is no longer a simple growth story. It is a complex narrative about technological execution, competitive durability, and geopolitical resilience. The alchemist has turned silicon into gold. Now, it must prove it can build a fortress to protect it. The future share price will be the market's daily report card on that endeavor.